Hello. Hi, everyone. Welcome back to the Founders Roadmap. Today's episode, I have someone who's so near and dear to my heart. I love everything she says, and she is full of wisdom. So today's episode is going to be amazing. It's called From Spreadsheet to Strategy. I have Cynthia Smith. She is the founder and principal of Shynvi, where she helps growing companies turn financial complexity into clarity. Cynthia spent more than a decade in corporate finance and operations at Fortune 500 companies, building a track record of delivering results. And she later jumped into the startup world where she got firsthand experience navigating the messy and exciting world of scaling fast growing companies. What makes Cynthia's ability to stand out, besides all of her amazing world of wisdom, is her ability to blend financial expertise with genuine partnership, which is so important in today's world. She's known as a transformational leader who doesn't just crunch numbers, she collaborates with founders and executives to align financial strategy with business vision. Through Shynvi, Cynthia combines her passion for innovation, technology, and helping others succeed, offering forward-thinking financial leadership to business pivotal moments of growth and change. She holds an MBA from the University of Chicago Booth School of Business and a Bachelor's of Science from Bradley University. She is based in Chicago. She's also a proud dog mom who loves climbing, bowling. Bowling? Oh my God, we'll talk about that. And exploring the city with her pups. Chicago's amazing. I got to get back there. But welcome, Cynthia. Welcome to the Founders Roadmap.
Thank you, Morgan. Thank you just for that amazing introduction. I really appreciate you having me on today. And I'm super excited to, impart my knowledge on the guests. I'm looking forward to it.
So I want to start with something that I haven't thrown at you in any of the prep questions, and I'm sorry. I have been calling your company Shynvi for, I don't know, like 9 months now, and I apologize. Where did the name Shynvi come from?
It's really a play on the word shine. Like, I think myself as the opportunity to shine in anything that I do. And from my perspective, it is allowing my clients to shine in their business at what they do best by taking the complexity out of their financials and removing that as an obstacle for them so that they can move forward.
Amazing. And while we're here, do you want to give a little bit of information about your role as both CEO and principal of Shynvi, a little bit about what Shynvi is and how you got it started?
Absolutely. So my company, it's completely fractional CFO services. And to distinguish between fractional CFO, you sort of have kind of two angles of that lens. And so that you have the long-term fractional CFO who might go into the company for a year and just be that CFO until the company turns around and hires a new one. And so that's more of a full-time role. In my case, it's fractional in the sense where it might be just a few hours a week. It could be for a short-term period of time, maybe a quarter, maybe it's a month or two, depending on what the client is working on. It could be longer, but it's still typically a much more focused in terms of short-term, a few hours a week or month, depending on what the client needs.
So, someone comes to you, and what does a normal client profile look like to you when they come in and they need a fractional CFO? Is it normally startups?
Sure. So my focus are really clients that are already operational within 5 million to 50 million in revenue. I
Wow.
do and can work with companies that are smaller or larger. But typically I'm working with companies that are either in growth mode, so they're looking to scale, or they might be going through some sort of transition. So maybe the ownership is changing hands, or there's
Right.
some other opportunity that they're trying to pursue, and I can help them out with the financial strategy for that.
Cool. So, okay, let's say I'm like a business owner and I'm like, I need a fractional CFO. I don't know what I'm doing with my money. I need someone to come in and help me tremendously. So I bring you in. What's the very first thing you would look at to assess like the financial health of my company?
For sure. So, to assess the immediate health of a company, I typically start with cash flow. So, key questions to uncover are: does the company have a healthy cash flow cycle and what's the runway? So, I'll look at things like changes in accounts receivable and accounts payable to see if the collections and payments of the company appear to be aligned with growth. I'll also look at the cash burn rate and overall cash runway. and I'll define those for you. So the cash burn rate is how much net cash the company spends per month, and the runway is how many months until the company runs out of cash at that current burn rate. So this takes into account operating cash flows. On the income statement, of course, I'll look at gross margin levels, consistency, variability, and how it supports overhead. So those two pieces there, cash health and margin quality, can give a good idea as to whether a company is in a strong position to fuel growth. Do they have breathing room to weather storms, or if there's more work to be done day one?
What is a red flag to you while you're evaluating those numbers? Even if those look great, are there other red flags that you can see in there that you're like, "Ooh, we need to take care of this first?"
Yeah, one of the biggest challenges is growth masking inefficiency. So, if revenue growth rates and overall margins look good, but you're not peeling back the layers, we might be overlooking risks. So, that's why it's so important to look at unit economics. Revenue can be scaling while unit economics are deteriorating. Another risk could be customer concentration. So,
Mm.
if a customer is profitable today, but the majority of the business's revenue is concentrated with one or maybe a handful of customers, the company is essentially operating in a very fragile environment where one unexpected change could spell disaster very quickly.
Have you on that note, have you ever been brought into a situation kind of that you thought was stable, or I guess the business owner thought was stable, and you were just kind of there to, casually get things in order, and you uncovered something and everyone was kind of like, "Oh my god, this is terrible." And you had to work around it?
Well, sometimes what a business owner really needs is just a clear, data driven view of the numbers to help them gain confidence to make a key decision that could pretty much reshape their strategy. So, if we're sticking with the theme of profit margins and unit economics, I work with a client who actually suspected that some of the products were not as profitable as they should be. So, after digging into the unit economics, I was able to confirm that a subset of those products were basically with negative margins. So my recommendation was pretty straightforward, and that was implement modest price increases. And at first, the client was hesitant, but once they saw the data behind it, they moved forward. And the change had no negative impact on customer demand. In fact, it was a turning point because it highlighted how well supported adjustments can unlock profitability. So the lesson is pretty simple. It's keeping prices flat year over year is rarely neutral. So if costs rise but prices don't, then margins erode. But if costs stay flat and prices don't move, the company's leaving money on the table. Right. So when we have external stocks like tariffs and supply chain issues, or things that a business are seeing today, but the prices hasn't been adjusted regularly, that risks customers facing sticker shock when there's a sudden large price increase, which often leads to pushback and then further margin depression. So, I mean, think about it. Uncovering insights into the number isn't just about analysis, it's about equipping the business owners to make a proactive move rather than reactive ones.
So, on that note, you brought up kind of the current economic situation that we're in, which I'm sure is making things really hard for your clients and I mean everyone. But so like now people are kind of holding their money in, they're not spending as much. Hiring's kind of gone down a little bit. Layoffs are kind of happening around. I don't want to say that word, but I will. So for people like you, fractional CFOs, even CFOs and finance people that work within organizations, when resources are kind of getting stricter, more limited, and those finances are getting tight, how do you prioritize what the company should invest in, where their money should grow, and if there's been like a pivotal switch in what you were telling them, kind of what they should work on versus like, ah, no, we can't do that now. I don't know if that's a good way to
Right.
ask that question.
Yeah. Well, it really depends on the margin of return of each dollar, right? So, if during this time period, if the sales growth is reliably profitable with healthy margins, then you can lean into growth. But if you're losing money with each dollar, then you need to fix the operational inefficiencies first. So, I would generally recommend most mid market companies stabilize their unit economics before
Mm.
they go with full stream into growth. So, again, we just kind of look at each of those case by case based on what's going on with that particular company.
I'm going to throw a question at you because I want you to define this. I didn't put this in any of our prep either. I'm so sorry for just kind of throwing things at you. When a sort of smaller company or a startup says they're in rapid growth, What does that mean to you, and is it a good thing? This is just for me personally because I've had a couple of people recently, like clients, tell me they're in rapid growth and they just spend money everywhere. I feel like when they say that. And to me, I'm like, I mean, good for you. That sounds really nice. But then all of a sudden, a year later, they're pulling back on all of those funds for the most part. Their contracts kind of get tighter. I realize they kind of cut maybe like 50 people from their staff. So when like a client says they're having rapid growth, to you, is that a red flag? Like, what does that mean for you? How would you advise your client?
Yeah, it's certainly not a red flag, but I think you touched on the key point is how do you manage that rapid growth? And then what metrics is the client actually looking at? So you can kind of have, well, we've got a ton of customers, and so we've got a lot of sales going on. But if you're not looking at, again, the unit economics of those sales, then you really need to be looking at the operational metrics. So you could be growing in customers, or you could be growing into a new segment, but you could still be losing money on each additional sale because your operational efficiency is not where it needs to be.
And I guess, sort of in that too, when you have a customer and they are using maybe like an old fashioned sort of past reporting on what they're doing, and you have times like now where things are a little bit unpredictable and we have any day now the market just changes, right? How do
Yeah.
you help founders make that leap from reporting in the past to using data to decide the future when things are a little bit unpredictable?
Sure. One of the first things I emphasize is the difference between accounting services and CFO services. So, accounting, as you mentioned, looks backward. So, that's last quarter, last month, or even yesterday. In contrast, what I do is forward focused strategic financial planning. So, that looks at what happened and then it asks, what does that mean for the business and where do we go from here? So, that means sitting down with the owner to understand the strategy, the priorities, and the risks that could impact the financials going forward. From there, I build a driver based forecast that connects decisions directly to the outcomes. So for advanced analysis, I typically layer in scenarios, typically high, base, and low cases, so leadership can actually see the different assumptions about growth, costs, and risk changes, how those things impact the bigger picture. The real shift happens when founders stop thinking about finance as a scoreboard or a dashboard of static numbers and start using it as a decision support tool that pretty much guides where to invest, where to pull back, and how to move forward in the future.
And since you I didn't realize that for some reason I thought like as a finance person you would kind of be in the weeds with past, present, future, like the ghost of Christmas past, present, future of money. But now that you mentioned that, and I know a big part of your approach is a partnership. So when you are kind of in the weeds with the business, I keep using that phrase, but when you're in there working with the founder, do you ingratiate, I think is the right word, yourself with like the CPAs, any other members of the team to kind of help not only your forecasting, but understand what they've done in the past and how things have run previously?
Absolutely. Accounting is the foundation of the business. That has the company has to have clean books. They have to have a solid hold on their books and their accounting function. You need that because if you're working off incorrect data, you can end up making some incorrect decisions going forward. So when I go into the company, I can work closely with all of their finance professionals, regardless of how big they are, and they're tremendously important to the outcome.
Do you find pushback sometimes from those departments if they have like internal, accounting or they use maybe someone on the outside, another kind of outsourced resource? Do you ever get pushback from those departments and you have to work kind of harder or in a more roundabout way to get those numbers and information?
There's always going to be times when people don't agree with perhaps the way the path forward, or that maybe they don't agree with the significance of a certain number or how to do something, right? You just really got to work through that.
Okay, so actually story time on that note. Has there ever been a moment where a founder or even like the accounting team, someone wanted to take one direction, they were super firm on it based on past experience, based on the data that they have, but the numbers or your forecasting pointed you a different way, and you had to bridge that gap and make those conversations and make those hard decisions?
Well, a common counterintuitive outcome is, for example, when a company is working with multiple customer segments and their largest customer segment by sales is turned out to be their least profitable. So once you factor in acquisition costs, servicing, churn, sometimes the economics don't hold up. So financial clarity can really reveal shifting resources to a smaller but more profitable and stickier segment drives healthier, more sustainable growth, even if that means pulling back from what looks like a bigger opportunity on paper. And once you give people the data behind it, it's really hard to dispute, "Oh, but I really love this." This is like my brainchild, and it's like, "What? The numbers don't support it."
So, kind of taking in a few scenarios here. With a startup, where do most founders go wrong with their forecasting, and how do you help that?
Yeah, so a lot of times with forecasting, people are starting out with sort of the best case scenario. They're starting out with like their vision. And while stretch goals are nice to have, and they certainly have a place in the company, having those in your forecast really can create a kind of unrealistic scenario, right? And it has you going off of expectations that are not realistic for the business. So, kind of pulling all of that back together and building off, again, data driven forecasts based on reality. And again, having those multiple scenarios that kind of helps ground people back. And the best thing about having the scenarios, honestly, is you're kind of encompassing a larger array of possibilities. And so you're a little bit more comfortable when you kind of fall outside of where you actually want to be.
Do you find that's more common than not that when you get in there, the forecasting that maybe, especially the founder, probably it just has this like crazy idea in mind and it's like way beyond the reality of the situation. And you're like, let's pull the reins back a little bit and look at what's actually possible here.
That is a very common
Okay, I thought so.
yeah, scenario.
I figured as much. Even like seasoned, I feel like leadership sometimes is just like they see the dollar signs and sparkles and glitter, and you're like, let's bring it back a little bit.
Yeah, you have to believe in your business. So you're
Yeah, I
like, "We're going
agree.
to do this."
It's just I don't know that 20 million. Let's just what let's bring it back a couple mil.
Exactly.
So, in that note, when you have to kind of bring down to reality, what are the leading indicators that you track to tell you whether a business is about to hit like a wall or it's positioned to scale? And you kind of answered that earlier, but I guess if you had to pick out the leading indicators, what would those be?
Yeah, so the same metrics that warn you of distress when moving in one direction also confirm readiness to scale when moving in the opposite direction. So it's two sides of the same coin. Now I'll go through kind of four different topics. So let's take the accounts receivable and accounts payable cycle. So when a company collects its receivables on time, it pays its vendors within a term. That signals that the balance sheet is healthy and that the company is ready to scale. But if collections are slow and the payables are stretched too far, then it points to a looming liquidity crunch. Secondly, inventory cycles. So fast inventory turns pretty much show that the business is converting its product into cash efficiently and they're keeping its capital free for growth. But if the inventory build up and it goes obsolete, it ties up working capital and that can pretty much drag the company down, which you don't want, obviously. If we also look at gross margins, I talked about that quite a bit, but stable, strong margins prove the business can scale profitably. But if the margin starts to erode, it's a warning sign that unit economics are breaking down. And then the last thing I'll point out is operating leverage and debt. So when revenue is rising faster than expenses, the company demonstrates true operating leverage and it's ready to scale. But if debt covenants are tightening and there's risks that lenders will begin to control the strategy rather than the leadership. So, to recap and just summarize all that, right? Healthy cash cycles, fast inventory turns, stable margins, and operating leverage mean that the company's ready to scale, but when you flip those, then you're looking at red flags for distress.
So I have a question. Let me see if I can frame this properly. So I worked at a company once and it was in kind of the business development area. Um, the company handled their margins really well. For their accounts receivable, they had like a decent turnaround time. I think it was like 2 weeks or something. I can't really remember, but the amount of time it took for their client to pay them was fine. However, Collections was terrible. They weren't like accounts payable wasn't doing anything. I couldn't get the CFO to get involved. Like it just was really terrible. And it was on me. It wasn't my job to constantly reach out and be like, did you send the check? Hey, here's the
Right.
invoice. Here's the PO, whatever. So like, let's say it's that business and you're my CFO and I'm telling you these are the problems consistently with the clients that we have. Technically, it's not our company's fault, but like how do you turn that sort of thing around if that's one of the indicators of a problem with what's going on? How would you help that situation? Just me being curious.
Yeah, I mean, that really just sounds like more of an operational thing, right? So they probably maybe didn't want to or didn't have the resources to invest in somebody to focus on collections. We'll talk probably a little bit more about this, but AI, automated billing systems, right? Having things that'll go out like automated reminders to people. So having these touch points where you don't have to have a human being like constantly making these calls can help people, the clients remember to pay their invoices and things like that. And I get it to your point, like, well, the collections is okay, but it could be better if we weren't dealing with kind of this. Let's try to follow up with these people every turnaround.
Yeah, it gave me a red flag of like, are we actually doing okay? So yeah, understood. But actually, we
Yeah.
can kind of, yeah, we will get into AI, but now that we're kind of talking on operational and metrics, if you had to pick three metrics that every company should track religiously, what would they be and why?
Let's see. We kind of talked a little bit about these already, but really cash runway, you know, how many months of breathing room does the company actually have? Gross margins by product or customer. And that's going to tell you where the business is making or losing money. Operating leverage, right? How much revenue is added without cost rising in lockstep.
And does that matter with like the size of the company, the how it's backed, if it's privately held, venture capital, like does any of that matter? Those are the standard metrics.
So all companies really should be focusing on all those things. There could be some difference. So, for example, a VC-backed company might they might track additional metrics, like something like burn multiple, which would be net cash burn divided by net new revenue, right? And that's measuring how much cash the company is burning for each new dollar. While a bootstrap founder really needs to be laser focused on the operational cash flow and profitability. So a lot of the stuff that we talked about very specifically before, and then middle market companies pretty much need to have a hybrid view, right? Balancing that growth ambition with liquidity preservation.
Okay. You're making things sound so much easier than when I just think about finance and how companies run regularly. And this is like, it's blowing my mind just to think about it from much simpler perspectives. So I appreciate all of this. But I do have one thing. I read about it. I didn't know what it means. And so I would
Mhm.
like for you to explain what these are and kind of what the difference is. So
Okay.
vanity metrics, what are they? And I can kind of infer what operational metrics are, but these came up in like, I guess the finance world of what you guys use. So if you could explain what they are and how they matter, if they matter, and the difference between them and if you care about them, I guess.
Yeah. So you can think about vanity metrics as things that look good in pitch books, but they don't actually pay the bills. So that would be something like the total number of users or the total number of revenue, right? So we're looking at
I
something pretty static,
see. Okay.
right? On the other hand, operational metrics tie directly to cash and margins. So, for example, customer count is a vanity metric while LTV to CAC ratio is operational, and that's customer lifetime value, right? So, the total value that you have a customer over the time of your relationship with that customer versus the cost to acquire that customer, right? So that's something that you want to know. Am I spending more to get this customer than what I'm going to get back from that customer, right? So these are things that matter for your company versus like, hey, I've got all these followers online.
Okay, I was gonna say, has there been an example you've worked with that was like all vanity metrics and you got in, you were like, oh no, oh no.
Well, I can't definitely not.
Okay, thank God.
But Other examples are if the company's focusing on revenue without profit, or if they're focusing on, again, the number of users without engagement, or they're focusing on website traffic versus the conversion to actually being customers, right? That's all noise unless it's tied directly, again, to cash flow or margins.
Interesting. Okay, that's really cool. I've never heard of those terms before, and I didn't real I thought they all kind of were just one big metric. Like,
Uh,
it seems like Twitter, X, whatever, is now like the vanity metric network, and they don't have any operational metrics, and that's why it's failing. And that makes more sense to me now. Why? So
I could totally see that.
cool. I'm smart now. I understand how everything works. So luckily you haven't been in that situation. Is there one specific vanity metric that you've seen distract a founder that you've worked with, and like the real operational metric that changed their business that you kind of brought to the table?
Well, the big one is going to be total revenue, right? So people get excited about seeing a large revenue number. But then, as we've been talking about today, is going back to the unit economics, right? So what's the profitability? What's the efficiency behind you getting that revenue?
Okay. Yeah, that I'm learning so much. This is amazing. So to bring some humanity back into numbers, Um, partnership is really important for you.
Mhm.
How do you, when you are meeting with a new client or you're prospecting for a new client, how do you talk to them on like a human level so that they can trust you to handle their finances, which to me is probably a founder's most prized possession, something they hold very close to their chest, letting you into that world where you see all their vulnerabilities, basically.
Yeah, yeah. So for me, when I'm first meeting a person, like it's really just, here's who I am and here's who you are, right? So just being on that human level, like I'm not coming in as someone greater than you or better than you. You know your business better than anyone, right? So I'm really just here as a strategic partner. And once I'm actually looking at the financials and having some of those tough conversations, I start with empathy first and then the data. So I'll typically frame it like if we're looking at some kind of affordability issues. I'll start with the business can't afford this yet rather than you can't afford this.
Nice. Okay.
And like I said, I position myself more as an ally and strategic partner, really aimed at helping them carve out a path to their vision rather than being a blocker. I stick with transparency. So I provide them options. And that might sound something like the company can't hire now, but if these critical metrics hit XYZ in the next 3 to 6 months, then it can, right? So that makes the discussion way more constructive.
That's a very optimistic way of looking at things. And I also think if companies, like founders especially, or if leadership talk to the entire company that way, it would also keep their employees less scared, I think. Um, so kind of like in that vein, if you've have you ever had those conversations, like the really tough ones where a company might be kind of financially struggling or at least heading into kind of a downward slope in their financials, and like the only option really was to we have to let some people go. Like that's kind of the only way this is going to work. Have you had to have those conversations before, or do you try really hard to like do everything else possible before that is the answer?
Honestly, you have to do what the data supports. So, as a finance person, what you're doing is again providing clarity, right? So we can't mask anything. We can't mask what the situation is. And I've definitely worked with companies that have gone through those types of situations, and when it gets to that point, it's really painful.
Yeah.
But it's it's really not the decision of finance to make that. It is like the finance to show you, hey, this is where we are, right? And here are the options.
Have you ever had a time when you had to deliver like tough financial news to a client, but then it got much bigger and better afterwards? Like you had that rough patch, but they were able to kind of rebound and do even better afterwards?
Yeah, so earlier I mentioned poor margins that can cause a company to shift away from a popular customer segment. So this could also refer to product lines. So on that note, let's take the example of a SaaS company that wanted to roll out a major new feature. If the forecast shows that incremental cost to launch those new features would push the cash negative, then the better decision might be to focus on improving retention and upselling existing customers first. And that would pretty much result in the increased cash flows that you need to fund future launches, right? So you can generally find your way forward, but you might have to take a different path before you get there.
Okay. Again, like I really like the optimistic look at things here. It's making me feel a lot better about my security, but everyone else's too. um, and then I'm just gonna drop that right back down to something terrible. So AI, which is coming for us all. I know you mentioned that you have a specific tool, and I would love to talk about that, like the different tools that kind of have developed to help and support the financial decisions, automation. But I also would love to talk about if there is kind of an automated tool, how AI is being used to think that it can replace like a human CFO or like take that fractional space. I personally don't think we're there yet, but I'm wondering if you have heard rumblings, in the trades of the finance world.
Yeah, you definitely have people who are like centered in AI and they're like, it's replacing everything. But realistically, right, in a lot of things, you really need that human element. So, from my perspective, AI and automation are powerful for things that are transactional, repetitive, and manual within finance. So, certain elements of bookkeeping, reconciliation, and even cash flow reporting. And most modern finance tools now already include automation and learning features that'll pretty much improve your speed and accuracy. So we even have like AI add-ons for Excel that can help build models more quickly. So when you look at that, we embrace AI. But the role of the CFO goes beyond processing data. It's
Mhm.
about comprehension, it's about judgment, it's about the context that the results are in, trade-offs that the company is going to need to make, and then communicating that to all the stakeholders, right? These are things that the machines can't replicate. So while AI will accelerate data for the strategy and execution, that still requires a human lens to connecting the numbers to the real world decisions.
And you mentioned a tool earlier that you like to use. Are there any that are out there, or I guess maybe that you've kind of had for a while that you really recommend that have made your life easier, made your clients' lives easier, that have been instrumental and helpful with your job, but not like we're coming to take over?
So for me, I mean, I might use again going back to things that are transactional, repetitive, and manual. So when you're building, let's say if you have to work in Excel, if you have anything that'll kind of ease the transition from the accounting system to your files, whatever you're using, those types of things. Like I don't want to promote any particular product, but
Fair, fair, fair.
those types of things drastically. Like, you don't wanna be, like, downloading files and copying and pasting, like, that stuff is so it just gets annoying and it just kind of takes up a lot of time. So anything that you can use that streamlines the process is super helpful.
Agreed. And then just your opinion, because I always want to know this. Do you think, like, using something like an accounting firm like H&R Block, doing your own self-reporting on taxes, is that, like, fine? Companies should do that, or they should really work with an accountant?
So in my opinion, you work with a professional unless you have that knowledge and expertise yourself. There are just things that they know and they can catch that you won't know, especially with business and different things that change, different kind of laws or things that change that might impact your business that they all know about and that's their responsibility to keep up on that you may not have even heard of. So it is generally beneficial, especially for something like that, to work with the professionals.
That was just a really hot tip that I wanted to make sure a professional got in here so that all my friends who have started startups on their own listen and get a real accountant and they don't get audited this year.
Oh, exactly.
Yeah, just because the IRS has had some downsizing doesn't mean you won't get audited.
Absolutely.
So kind of on the same of streamlining for like a very lean new startup. What financial processes are non-negotiable versus nice to haves, like in layman's terms? If I'm starting up, I understandably probably a human accountant, but like what other things should I have from your perspective?
Yeah. So For sure, you need to have clean books, right? So you need to have somebody applying your expenses and revenues to the right categories, right? So that's support for working with a bookkeeper and accountant, monthly cash reporting. They're going to show you exactly what's happening, and then basic forecasting. Right? So basic like what's going to happen in the future. That's stuff that you should be doing for sure. But then do you really have, right, things like advanced BI dashboards? Do you really need multiple, multi-scenario modeling or full ERP systems, right? Not necessarily upfront. Those are things that will come as your scale justifies it, but these are still things you want to keep in the back of your mind.
So are you saying, well, I don't know what I'm saying, but essentially, personally, from my point of view, what you're saying to me is even if it's like before seed funding, I should be having those things in place.
You should have a plan to put them in place. Like if you don't, so when someone first starts a business, they should have some sort of financial model that says, "This is why my business is going to be valuable because viable. I'm gonna make this amount of money. I'm gonna sell this number of units. These are what my expenses are gonna be." Like, you need to see that stuff, and so for an initial financial model, it can be very high level, but once you get into actually taking in revenue and things like that, you need to have you should have an actual online system in place that's recording that stuff for you, right? You should no longer be operating just in an Excel file to manage your, essentially your books.
And not just vanity metrics, people. Not just
That's
vanity
right.
metrics. We have learned from this podcast that's not what we're doing anymore.
Absolutely.
So, all right, we've started everything. We've kind of got our financial processes in place. We're streamlining. We've got our automations down. Now we're thinking about growth and scaling, which we kind of touched on earlier. But are there any financial blind spots that tend to kill the scaling process when we're trying to get there?
Yes. So
That
one
was the
big one,
saddest yes. Yeah.
this is stuff that people run into all the time, but like overhiring ahead of revenue. A
Yes.
lot of startups might start with like the kind of top heavy, and so they have really, really heavy expenses for salary before they've gotten any really good revenue in. And then there's a flip side of that that I won't go into, but then they're also maybe not investing in systems early enough. So again, going back to you got to get out of that spreadsheet and you got to have some sort of system. You got to have some professionals coming in, and then ignoring working capital. So again, going back to hey, revenues are growing, but do you have the cash to fund it, right?
I feel like the what you just described, the overhiring and exponential salaries was the entire post-COVID problem of layoffs. Like my husband used to work in tech recruiting, and so he was just
Mm,
like job after job after job after job,
yeah.
and then it was like, nope, sorry, we hired millions of you, and now we no longer need you. Yeah, got it. Um, and I kind of want to ask you, I don't know if it's like a touchy subject, but whenever you are working with a company, you mentioned that there's different models of how long you will work with the client based on their needs and when you think, we've done everything we can do here. So when would you advise a company that it's time for them to bring maybe an in-house finance team and like your job, you're done, you've done it?
Yeah, and that I will not say that that's touchy because it's absolutely needed. I've talked to people before even taking on something, and I listen to what it is that they're dealing with, and I'm like, it sounds like you need to hire somebody.
This is, I'm tired. Please hire someone.
No, just like what's actually going on in your company, you are ready to hire someone. But typically fractional CFOs work well until finance becomes a daily strategic driver, right? So
I see.
usually up to like 50 million in revenue or complex capital structures. Before then, a hybrid approach will work with a fractional CFO and a strong controller, right? So you got someone who's good in accounting, but then you also get someone who's going to be forward focused with your financial planning, and that's usually most cost effective.
Do they ever just wondering after they bring someone in because you've kind of formed that partnership with them, do they ever bring you back just to consult like for fun with the new CFO that comes in?
Typically, you can certainly stay on for consulting, and what's actually really really helpful. It's just like in any other job, right? Like if someone's transitioning to a new role, ideally, it's super helpful if you can have that person be there when the new person gets in, and
Right.
they're like imparting the knowledge, and then you can head out. So that's absolutely regular.
I imagine that's a much better scenario than like I don't I get the vibe that with leadership in general, the C-suite, there's normally when one of them goes out, it's not a lot of good vibes when a new one comes in. I get that vibe a lot. So I feel like with this situation, it's kind of perfect because it's all just we're here to help each other. We're here to help the company. And if you need me, I'm here. If not, like totally fine. Just let me know. So I feel like it's in the best interest of the company to have that kind of working relationship with each other.
Yeah, and that's what I love about it, and that's really, I would say, the sweet spot for companies is that you don't have to keep the talent, right? If that doesn't work out, you can get somebody else in.
Um, you don't have to answer this if you don't want to, but like based on how you work with clients, do you sort of have like an open contract with them, or do you do your like, I'm gonna analyze what you have going on first, and then I'll decide like, oh, if you want to keep me for 6 months, we'll reevaluate at that time. And I'm curious of how you plan to work with the company based on like the initial courting period.
Well, yeah, that initial period, we establish up front, like what the client wants, and then kind of either if it's project based, right, then
Mhm.
here's the project, and the contract is around the project, or if it's time based, right, I want somebody to come on for the next 6 months, like that's established up front, and then after that is over, that period's over, then we can talk about something new if the client wants an extension or something like that, or they needed completely different focus.
I see. I would love to hear a client success story that you have where you, because of you, having you there, you helped them scale successfully because you gave them the right financial clarity, the right processing, the right information. I want to hear your success, Cynthia. I want to hear all about it.
Well, what I can tell you is what I bring to mid-sized companies is the ability to connect corporate level financial discipline with startup level agility based on my background, right? Most companies in the 5 million to 20 million revenue range have outgrown simple spreadsheets and gut feelings, but they don't yet have the internal financial structure of a large corporation. So that's where I step in, right? And ultimately, I help business owners translate finance decisions into, or pretty much their finance, all the numbers, the data, help them translate that into decisions. So if you think about it, it's turning data into clarity. I'm building forecasts for them, segment analysis, cash visibility that don't just show growth, but show whether the growth is sustainable and profitable, right? I also help with balancing growth with liquidity. So scaling doesn't break working capital or debt confidence. And I help guide investment priorities so leaders know which opportunities to create real value and those that will dilute focus or margins, right? So, in practice, what this means is that founders avoid those classic middle market pitfalls. And that is, we talked about already, overhiring ahead of your revenue, scaling unprofitable segments, or burning cash faster than it can be replenished, right? So, instead, my clients gain confidence to scale with discipline. They know the numbers that support the strategy.
So, you've given me so much to work with in this episode, and I feel like I'm going to listen to it a million times just to get as much advice as I can out of this. But you also have such a, I don't know, a spark and like a liveliness when you talk about what you do and how it helps people and companies, which is really amazing. I don't know. You just like, you never, minus the one question with the financial blind spots with but everything else has been just like, you're so happy talking about it. If you could sit down with your younger self, your younger founder self, what financial lesson would you hammer home to her?
Yeah, so really, just going back to what we talked about earlier, and that's focusing on cash flow and margins, right? So, not looking at those vanity metrics, and really focusing on the operational aspects of the business.
I feel like we are subliminally messaging people with like using the same keywords over and over until they get it.
Exactly.
I guess we're very close to wrapping up. What last piece of advice besides the vanity metrics, and the margins, what would you have for anyone trying to find you and seek you out, but might be like scared to approach you?
Let's just have our conversation. I'm not that person trying to force my services on you. Like I mentioned, I'll absolutely tell you if you need something different other than what I provide is the conversations are free. Let's just get to know each other.
And lastly, you work with anyone everywhere, right? So not just like
That's right.
Chicago. Could you work with like a company in Dubai, let's say?
I don't do international,
Okay.
and I
See,
can't say I for sure know anyone yet who does international, but uh, I can work nationally across the US.
it's good to know. And then I have one final question that I would love
Okay.
to ask you. What has been your proudest, like most proud moment within your career so far?
Yeah. So as far as, being a business owner and doing finance for mid-sized companies, what makes me proudest isn't one single moment. It's the recurring experience of helping hardworking business owners translate financial complexity into clarity. And that drives their strategy forward. In the corporate world, it can feel like being a spoke in a very large wheel. So decisions are layered and the impact can be hard to see. But in this market, in this instance, it's completely different. The financial clarity I bring, whether it's cash flow visibility, margin analysis, or scenario planning, can directly change the path of the company that I'm working with. And the best part is really watching the founders gain confidence to make a big decision. They're avoiding costly mistakes or pursuing an opportunity that they didn't think was possible. So the numbers stop being intimidating and it become a tool that empowers them to achieve their goals. They're protecting their employees and they can scale with confidence. But for me, it's really about being a true partner in their success rather than just reporting the numbers.
You heard her. You heard her. It's all about you. It's not about her. She's the perfect partner for you. Well, that honestly, that wraps it up for the episode. I've learned so much that I didn't think I would learn today. And I'm so happy that you came here to explain everything about your job, the finance world, and honestly, everything you could possibly know as a business owner about how to have a healthy, financial, stable company. Um, Thank you so much for being here.
Yeah, Morgan, thank you for having me. I really appreciate it.
Yeah, we will have you back. I have tons of more questions to ask you, so we'll have to think of like 10 more episodes to do with finance because I fear now that I might be audited. But thank you. Thank you, Cynthia, for being here. Thank you, everyone, for listening to the Founders Roadmap. I'm your host, Morgan, and I will see you in the next episode. Be sure to click subscribe, like however you listen to your podcast, YouTube, whatever. And we'll see you soon. Thank you.
Thank you.